2025 was another incredible year for technology stocks, but it's starting to flatten out. The question is, what does it mean for your hard-earned retirement savings? Stay tuned this week's episode of the Retirement Income Source, where it's all about the income.
Welcome to the Retirement Income Source, where it's all about your income. I'm Sarah Samuels here with David Scranton, and we appreciate you spending some time here with us this weekend. We hope everyone is staying safe out there. There's been some crazy temperatures over the last couple weeks, really. We're even getting them down here in South Florida, but I hope everyone out there is staying safe with this winter storm that's going on.
I know, high temperatures of 60 degrees in southern Florida. Imagine that.
It gets even lower. It's in the 50s even. It's pretty...
40s at night, yeah.
Yeah, 40s at night, down in the 30s with the wind chill factor. So it's pretty cold down here.
And up north, I get reports back from Connecticut, my office there, and down the shoreline, I think they got about 1.5 feet, and further up north in the state, they got closer to 3 feet.
Yeah, how are they faring up there? Everyone's doing okay?
Oh yeah, it's better now. It's cleared out now, but it was that storm was a big storm, and a lot of people said to me, they sent me pictures out there, taking pictures from out inside their homes and saying, this reminds me of the old days, because we used to get these storms all the time years ago, and lately it seems like there's just, a smaller and smaller amount of snowfall.
Yeah. Well, it also seems, too, it's a little bit later in the year since it's end of January. But it seems like, Dave, there might be a storm brewing, at least when it comes to the Magnificent Seven. And there are a lot of people that are over-invested in these stocks. And it's important for people to remember that out of the S&P 500, those Magnificent Seven stocks, there's 493 other stocks as well.
That's right, because there are 500 stocks. And
simple math. Even I can do it.
And here's some interesting statistics, and this has started to change so far this year. But last year, 75% of our economic growth was from the technology companies that we're discussing, 75%. Over the last 2 years, ending in October 31, JP Morgan published a report that said that 75% of the growth in the S&P 500 in the stock market came from artificial intelligence, came from companies that were involved in AI. So, moreover, when you take last year's performance in the stock market, Sarah, if you equal weight it, because those big companies, big tech companies, have a heavier weighting. You might think, gosh, if it's one company, it's 1/500th of the index. Well, it's really not. It's much bigger than that if it's a big company, relatively speaking. So if you equal weight all 500 stocks, that cut the return last year in half. It went from 16% down to 8%. So again, a lot of the returns that you've been seeing in the stocks in the market overall in the last 2 years has been from those big seven, those Magnificent Seven stocks, not the other 493. But Sarah, so far it looks like this year it's starting to even out. I mean, we're still only 1 month in the year, but it seems like the non-tech stuff is doing the same, if not better, than the tech stocks.
Well, Dave, for a lot of people that are maybe looking at what's going on in the AI world, with some of these new reports coming out that the AI wasn't as effective as these companies thought it was going to be, all kinds of new reports. What do you think that means for the growth that we saw in the economy? What happens if this turns into a situation where they're overpromising and under-delivering?
Well, in the 2 years in that period ending October 31st, the one that JP Morgan reported, 90% of capital expenditures in the market were for artificial intelligence. 90%. That's a big investment all these big companies are making in AI. And I think what you're referring to is that recently they're starting to realize, wait a minute, we don't think the payoff is going to be as big as we thought it was going to be. These investment returns are not going to be as big, or maybe not even be positive. So, because the stock market looks ahead, it got over its skis over the last couple of years with these Magnificent Seven especially, drove the price of these stocks up, but now everybody's saying, well, wait a minute. If it's not as profitable 5 or 10 years down the road as we thought, then maybe these stocks are overvalued. And that needs to be a concern for anybody that's lopsided in these technology stocks.
That's one of the major risks that we cover in our special report about the 7 risks to your retirement. People that are overly invested for growth in the stock market, especially if you're overly invested in the Magnificent Seven, because I know a lot of people, they had that sense of FOMO or fear of missing out. They saw that growth. They wanted to jump in or at least stay in. They weren't ready to make that transition yet. But we have that 7 risks for retirement report available. You can go on to our website retirementincomeradio.com and download that absolutely free. And you're listening to The Retirement Income Source, where it's all about your income. I'm Sarah Samuels here with David Scranton, and we're talking about the dangers of being too overly invested in the Magnificent Seven, the 7 stocks out of the other, in the S&P 500. Of course, there's 493 other stocks. And Dave, we're talking about how a lot of the growth has come from this belief and this investment and several big corporations in AI and that technology. What happens if this turns into a situation like we saw in 2006, 2007, where a too big to fail situation where they're way over leveraged?
Well, what's interesting is these companies won't fail. During the financial crisis, what you're referring to, we saw basically, all these credit default swaps where company A borrowed money from company B borrowed money from company C, and company C borrowed money from company A. It was a big circle. If one failed, they were all going to go down like dominoes. But what you have to realize is that even going back to the year 2000, when the tech bubble burst, it took till 2018 for most technology stocks to get back. So it was underwater for 18 years. Now, even then, you have to realize that back then, a lot of those companies weren't profitable. These companies are profitable because they're still big companies that are making money. But what they're doing is they're eating up a lot of money off their balance sheet to make these investments. And if they ate the money up off the balance sheet and the investments really don't pan out, that has to affect the stock performance for a decent period of time. So would it be 80-90% drop in tech stocks over 18 years? Maybe not, but could it be half that for half as long? Sure.
And that's what people are referring to really when they talk about the potential for this AI bubble bursting.
Mm-hmm. That's right. Because we've seen this in different parts of the market. Like right now we're seeing gold and silver, right? And a lot of people are saying, well,
gold just hit 5,000.
That's right. And silver's over 100. So they're saying, well, gold and silver are going up because it's a problem with the fiat currency and people are worried about hyperinflation and everything else. Well, there's a little bit of that started it. But what's really happening is speculators are taking over and they're driving it up. And financial institutions are involved and they're driving it up. So it's not so much a worry about that as it is just speculation. And we've constantly, in various parts of the financial markets, have had bubbles. And bubbles do burst over time, and some are worse than others. So again, I don't think this would end up anything like what we had when the tech bubble burst, 25, 26 years ago. But we still need to be careful. And, if you're retired or you're approaching retirement, meaning in the next 10 years, you want to be better diversified. Even if you're in mutual funds, a lot of mutual funds kind of follow the S&P 500, which means they're weighted really heavily toward these tech stocks. So you need to be careful. You need to be really diversified across industries, or in some cases, maybe just diversified, between different asset classes. In other words, not even all of it in the stock market, having some in bonds and bond-like instruments and other things too.
It's all about diversification. That's really one of the best ways you can hedge your bets. But if you're within 5 to 10 years of retirement and you're heavily invested in those Magnificent 7 stocks, now might be the time to make that change.
Yeah, I mean, absolutely, because, it's one thing when you're in your 30s and the market's underwater or the tech sector's underwater for 18 years, you have time to recover. But when you get within 10 years of retirement, or especially if you are retired, you may not have time. Moreover, those stocks typically generate no or very little income, very little dividend. And to me, that's the biggest problem, is that not only do you want to protect your principal as you get closer to retirement and be more diversified, but you also want to be in things that are income first and capital appreciation second.
Yep. So diversification is important, but it's also what you diversify into, right? What you're investing and why you need to be making that switch, especially right now with the Federal Reserve, what they're doing with pausing the interest rates now might be the last few months where you can really lock in those higher interest rates. We'll talk a little bit more about how you can diversify and protect yourself against any potential stock market swings that we might see coming up in the future. I'm Sarah Samuels here with David Scranton, and you're listening to The Retirement Income Source, where it's all about your income. Welcome back to the Retirement Income Source, where it's all about your income. I'm Sarah Samuels here with David Scranton, and we are talking about the dangers of being too heavily invested in the tech stocks and the S&P 500, specifically these Magnificent 7 stocks. So let's talk about some of those statistics, Dave. We mentioned a few minutes earlier. So we've seen 75%, that seemed to be the number here, 75% of the growth in the economy we saw it came from these tech stocks, or from technology in general.
Last year, right, from technology and AI, sure.
And then 75% of the gain in the S&P 500 also came from the technology stocks. So
over the last 2 years.
Over the last 2 years.
Ending on October 31st, according to that JP Morgan study, correct.
So what we're seeing here is that a lot of these tech companies, they've had a pretty good run. It seems like they've been going up. A lot of people have wanted to invest in those companies. But do you think we could be seeing a turn in that at this point?
Well, it's going to happen eventually, and whether this is just a January that's different, that's more diverse in the market gains, and then we go back to what's been the norm for the last 3 years, I don't know. But what I do know is that you take 500 stocks in the S&P 500, and those large 7, the Magnificent 7, comprise over a third of that index. So you're thinking, wait a minute, you should be 1.5%, right? 7 divided by 500 is like 1.5% of the index. No, it's 35% of the index, to a point where even last year, if you equal weighted every stock, so every stock was 1/500th, you've cut a 16% return down to 8%. And call me crazy, but you don't need the stock market to make 8%. Certain bonds can make 8%, certain preferreds can make 8%, all without the risk of common stocks. But the reason it shows much higher is because the weighting toward those 7 companies. So that just got to ring an alarm somewhere to say, okay, this can't last forever. It's like the game of musical chairs. At some point, the music's going to stop and someone's going to be stuck without a chair. And the sad news, if you're a regular listener to the show, is that the institutional players can usually pull the trigger a lot quicker and make adjustments. So a lot of times it's the little investor, the mom and pop investor, that's stuck without the chair when these things reverse course.
Exactly. It's like those folks that were relying on the withdrawal strategy right before 2000, right? Right before the dot-com bubble burst, because it was 13 years that we were underwater between 2000 and 2012.
And that's why the other lesson here is, not just, diversifying better, but the other lesson is going to an income first, capital appreciation second strategy, right? And the problem, Sarah, is right now a lot of people have forgotten because, if you retired in 2008, 2009, 2010, 12, and you used a withdrawal strategy, you'd probably be okay because it was at the bottom of the market. So people have forgotten now because it's really been 25, 26 years where if you retired back then using a withdrawal strategy, meaning selling shares every month to get your so-called income and then hoping that it grows back, it's really been 26 years since that strategy really backfired, right? But everything goes full circle again. And if you don't transition to an income first, capital appreciation second strategy, then you're gambling. You're gambling and rolling the dice that you retire and the markets will be strong for you those first 10 years of retirement. And that's a big gamble.
Yep. And we put together a special report just for our Retirement Income Source listeners. It's called the Universe of Income Generating Investments, so people can really educate themselves on all of the different options available in the stock market and the bond market, all depending on your individual risk. And you can download that report. Just go to our website. It's incomeradio.com, and you can download that report and really understand some of the investments that we're talking about that really are income generating. You're listening to the Retirement Income Source, where it's all about your income. I'm Sarah Samuels here with David Scranton. And Dave, we're talking about the big mistake that pre-retirees are making, especially if they are overly invested in the Magnificent 7 tech stocks and the S&P 500. And you brought up a great point that people's memories get short, right? We tend to remember the good things. So it's been 26 years since people really may have been impacted by having using that withdrawal strategy, selling off stocks to make it work and counting on the capital appreciation or growth to make up for it.
Yeah, if you retired in the late 90s through the early 2000s and used that strategy, you'd have a problem because your early years of retirement, the performance wouldn't have been there. And as you're selling shares withdrawing principal, which by the way is what a lot of advisors still do, they sell shares, they withdraw principal, they send you a check, and they call it income. but it's not really income, it's principal, and then they're crossing their fingers and hoping it grows back. Now, what makes it more confusing is you may have to pay taxes on it. The IRS might call it income. Why? Because it's money that was in a 401k or IRA. But please make no bones about it. If it's not being generated from interest or dividends, it's not income. It's taking principal and hoping that it grows back. So yeah, during that time, people would have done really poorly. And that's part of it. So yes, you have to go to an income first, capital appreciation second approach. But the other part of it too is that a lot of you may not even realize that you're as heavily leaning on those Magnificent Seven stocks as you are. Why? Because if you are heavily invested in mutual funds or exchange traded funds, you may think you're diversified. You may look at the fund, it may have 200-300 different holdings in it, and you think, hey, that's great. But most of those funds don't deviate too far from the index. Why? Because for fear of underperformance, they know that if they underperform for a couple years in a row, they're going to lose a lot of investors. They're going to lose revenue, and the fund manager knows that he or she will probably lose his or her job. So as a result, you find that they're what I call closet indexers. They typically tend to be allocated a lot like the index. So if the S&P 500 index has its top 7 stocks comprising over a third of the index, then you might not be surprised either to look at some of your mutual funds or exchange traded funds and find out that anywhere from a fifth to a third to even more could be in those top 7 companies. So you have to be careful. Sarah, there's times when the markets are doing really well overall and investing in a mutual fund or an ETF is fine. You're just, the tide's coming in, all the boats rise. But then there are times when things don't work the way you expect, where all of a sudden those strategies really fail. And there's a big benefit to having individual securities, individual stocks, individual bonds that you can choose so that you can be better diversified across sectors and not just rely on the fund itself.
Right, because it's not just about diversification. It's also making sure that you're invested properly for your proper stage of life, right? Which is making sure that you're not in mutual funds, ETFs that are not going to be generating income the right way through interest and dividends.
And that's a good, second point is that most mutual funds and ETFs are really for more capital appreciation. Usually the interest and dividends, the income component is a second thought, second consideration. Now, there are some out there, a few, that might have income as a primary. But, for example, even then, one of the problems with exchange-traded funds, Sarah, is if you have an exchange-traded funds and let's say it pays out a lot of income, sometimes they pay out more than just the income generated by the securities because just the workings of how they have to declare income in advance. Oftentimes, you might find that the securities down there are paying a 4% income, but the fund's paying out 6%. So that means the other 2% is really coming out of principal. And that's kind of misleading. So again, it's when the market's doing great, sometimes something that's a little more opaque, like an ETF or mutual fund is great. But when things start to turn, and they started to turn in January, right, because a lot of the non-tech stocks have started to beat the tech stocks this past month. When things start to turn, all of a sudden, that opaqueness, if you will, is not good. You need full transparency. And frankly, the best way to do that is through a portfolio of individual stocks and bonds.
And Dave, let's talk a little bit more about what kind of stocks people should be thinking about being invested in, especially if they're looking for an income first approach. And we're also going to be taking some questions. If you have a question, we would absolutely love to hear from you. You can call in now to our Ask Dave hotline. That phone number is 833-RIS-RADIO. That's 833-747-7234. I'm Sarah Samuels here with David Scranton, and you're listening to The Retirement Income Source, where it's all about your income. Thank you for spending some time here with us this weekend on the Retirement Income Source, where it's all about your income. I'm Sarah Samuels here with David Scranton, and we've been talking about some of the mistakes or some of the dangers of investing too heavily in the 7 stocks, the Magnificent Seven, as they're calling them, and being too invested heavily in technology as a whole, as we saw a lot of growth in the economy come from AI, come from technology in general, David. And you mentioned that right now we're going into that time where it's going to make way more sense for people to have a portfolio of individual stocks and bonds that generate income the right way, as opposed to relying on growth or capital appreciation really in the markets.
Well, yes, that's always true when you're retired or within 10 years of retirement. But what's also happening now is all these, again, that we mentioned earlier in the show that most of the gains in the market over the last couple of years have come from AI, tech companies that have a large AI component. And what's starting to happen now is they're starting to say, wait a minute, this investment that we made in AI, we're not seeing a clear path to profitability. We thought it would be profitable to a very high level, and now it might be profitable to a much lower level, right? So that means the possibility of an impending pullback in those stocks. And of course, when you're making the transition to an income first, capital appreciation second approach, you want to do it when two things are true. Number one, when your stock values are high, so you're getting out at a good time. And also when interest rates are high, so when you go into income first strategies, you're getting a higher interest payment. And all I can tell you right now is if these projections are true, that the return on investment from all these artificial intelligence investments that corporate America is making, if they're less profitable than we thought, then that can mean a pullback in the stock market. And we also know that there's a push to lower interest rates a lot more, especially with a new Fed chairman possibly in May. So to me, that adds up like the perfect storm in a good way, Sarah, where now might be the perfect time for those who haven't made that transition to take it seriously in the next 2 or 3 months.
Yeah. Really could be the last time to make that transition, right? Or to have
for a while, sure.
Be true, right? Where you can sell off your stocks at a good place and also still have those high interest rates with the Federal Reserve pausing rates right now. So still a last minute chance. And we still have a last minute chance for anyone that has a question for our Ask Dave segment. We'd love to hear from you. You can call in. That phone number is 833-RIS radio. That's 833-747-7234. You can also go to our website, incomeradio.com, and put your question to the show there. So let's get to our first question here, Dave. It's from William in Cheshire. He says, Dave, you talk about diversifying in the stock market to be more equally weighted, but what about outside of the stock market?
All right. Well, William, correct? William, yes. So, when I say stock market, I mean common stocks, right? Like we typically think about the stocks that are in the Dow or the S&P 500 index. So with that, I'm going to answer the question based upon that assumption. There are lots of other things that you can do outside the market, right? There are bonds. And of course, you have government bonds that are safest, and you have municipal bonds, which can have a tax-free component. And then you have corporate bonds. But you have to be a little careful because bonds are essentially an investment where you're making a loan to a company. So you have to worry about the credit worthiness of that particular company. So you have to look at the credit ratings and due diligence that's different from what you might do picking a stock. Okay? Then when you get out of the bond world, you get to preferreds. Preferreds are technically a class of stock, but they're more bond-like in many ways. Number one, they pay an interest payment that they call a dividend that's fixed. So even if the value of the preferred share goes up or down, your payment of that dividend is fixed. Then you've got other things which are truly more bond-like stocks. So you have business development companies and real estate investment trusts, right? Business development companies lend money to smaller businesses, right? So if you're a huge company, you're going to go to Goldman Sachs, you're going to issue a whole bunch of bonds to the public, and you're going to borrow money that way, right? And then you can invest by being a bondholder. But how do you invest in the smaller companies? Well, there's certain companies that are too big to go to the local bank to borrow money, but they're too small to go to Goldman Sachs. So what do? They borrow money from a BDC, a business development company, and you can invest in these companies, which are like pools of loans. And last, of course, the real estate investment trust, where you're investing in a stock that owns rental property. A stock that owns rental property, you're getting flow through of the rental income. So again, the last two are truly bond-like stocks, but there is a big bond-like component. So I kind of put those in a separate category. So William, I hope that helps.
William, thank you so much for submitting your question via our website. That's incomeradio.com. And we'll make sure you get a copy of the Universe of Income Generating Investments white papers. You can understand all of these different investments that Dave is talking about and how they can help generate income. Mm-hmm. Let's get to our next question here. We have Jill from Hartford. She said, I'm still working. Most of my money is in my 401k, but I see that the options are really stock-based. What should I do for the time being?
Well, Jill, unfortunately, most options in 401ks are stock-based. They may have one or two bond mutual funds in there. Bond mutual funds have their own problems, though, because they lack the assurances that individual bonds have. So when you own a bond fund, you essentially own the stock of a company that owns bonds. So bond funds are not a great alternative, even if you do have one or two options in between all the stock options that are in your 401k. Most, though, do have a fixed interest option. And you might be fortunate, you might be with a company that has a competitive fixed interest option, like maybe 4%, or you might be unfortunate and be with a company where the fixed income option is only 1%. But that's something that's usually a lot more secure. But I will share this with you too. There are a couple of other options. Number one, if you have a 401k with a previous employer, you can always roll that over to an IRA, and then all those investment restrictions go away because it was with a previous employer and you're not there anymore. In addition, if you're with your current employer, most companies today have the ability to do what's called an in-service rollover. So when you turn age 59 and a half, even if you're still working, you can roll a majority of that 401k money over to an IRA, and again, now have the universe of investment options to choose from. So it lifts those restrictions. You can keep working, you can keep putting money in your 401k, you can keep getting the match, but you've taken a bulk of it out because you're still working and you're over the age of 59 and a half. If you're under that age and you're still working, well, you might just be stuck trying to balance it between the stock funds that are in there and hopefully a reasonably competitive fixed interest fund. So I don't know your personal situation, how old you are, close you are to retirement, but I hope that helps.
Jill, thank you so much for sending in your question via our website. Again, that website is incomeradio.com. If you have a question, you can also call into our hotline. That's 833-RIS-RADIO, 833-747-7234. All really good questions that we got from our listeners.
As usual.
As usual. We always get really
I expect
good
nothing less. That's right.
It's a good, too, to highlight the importance of rolling over your 401k to the IRA, why that's so much better than the investment options in the 401k. Maybe we could do a future show on that topic.
Oh, we probably should. I think it's a great idea. And you know, there are a couple of small benefits to a 401k. Like if you retire at age 55, you could take money out penalty free, whereas in an IRA you have to wait till 59 and a half. But if you do a Ben Franklin, all the pros and cons, most of the pros are in the column of having your money in an IRA. A lot more flexibility, a lot more control, and certainly a lot more variety.
Absolutely. Well, we appreciate you spending some time here with us this weekend on the Retirement Income Source, where it is always about your income.
And most important, we hope that you're here with us next week, same time, same station. I'm David Scranton here with Sarah Samuels, and you've been listening to the Retirement Income Source, where it's all about your income.